Here's your chance, Corey.
Let's talk about this.
Well, we'll make this talk to you.
All right, sounds good.
What's going on with the Tom?
Hi guys, I'm Slav. So I know that predicting absolute lows in the stock market and that in equities in general is like very difficult and almost impossible. But do you think that, I mean, I know the oil questions have already been asked in a way, but do you think that buying now is at least close enough to the low to stay on the roller coaster, not fall off and get hurt, go through that dip, and then just enjoy the benefits? Maybe in the next year or two? Do you think that now is at least close enough to the low where if you don't need that money, you can jump in now and enjoy the benefits in the future?
Can I ask a caveat question to you? Is what time horizon are you giving for that question? Like, are we at the low? I think your question is this the low, and what's the time horizon we look for?
I mean, the time horizon I'm looking for is I'm really in no hurry for them to go back up. But if it's close to the low, then I can probably hold on for at least 2 years and then enjoy benefits. I mean, they'll definitely go up from where they're at now, right? They will eventually.
It's got a little desperate, guys.
And my point of asking that question is, depending on time horizon, the answer is who knows. And could the stock market go from 15.5 in the Dow today to 6,800 by the end of the year? The answer is absolutely, you can do that. I don't know if anyone's kind of would think that that's exactly what's going to happen with the Dow, but we saw it in 2008 where the market retracted by 50% in one calendar year. So it's totally possible that this could go lower. Oil could go lower, equities could go lower, everything could go lower. I remember going to school here, and Tim Smavey was my professor here, and said the stock market has a 50% chance of going up and a 50% chance of going down every day. And so there's a possibility, I think, of up and downs in the short term. But if you're asking me over the long haul, a 10-year time horizon, whether you bought oil at $27 a barrel or the S&P 500 at 2,000 or 1,900 or 2,200, the markets typically double every 10 years. And when I look for my advisors 10 years from now, whether you got in at today or a month from now or 2 months from now, when you have a time horizon over 10 years, you're going to benefit in growth over a 10-year time horizon.
I forgot to answer an earlier question about what I think about the commodity prices. I recently bought a bunch of silver, gold, and Freeport-McMoRan, which is a mining and oil company. So just in the interest of full disclosure, yeah, and Freeport is, what did you say, silver? So is this a bottom? Obviously, I thought it was a bottom at $40. And it's been painfully evident ever since last summer that it's not $40. But I am buying. I don't know if it's a bottom. At this point, it's trying to catch a falling knife. But I think over the long term, as old as I am, I still have a time frame longer than 10 years.
I'll echo that. Actually, moved my entire 401k to equities about 4 days ago. I look at it just pretty from like a large standpoint. I say the market's at 16,000 points today. Do I think it's going to be higher than that like a year from now? And I do think so. I think the emotion that's going on right now is like it just super intense. And Warren Buffett has a great quote, which maybe you have already heard, but it says that when others are greedy and fearful, when others are fearful and greedy. And, that's a nice way of saying that when things are in turmoil. I mean, look back to 2008, that we had systemic problems in the global economy. And I'm not saying we don't have some of those same things today, but it was the best buying opportunity of most people's lifetime. And a lot of people think the same thing today about commodities in general. And I kind of tell my clients, like, I don't look necessarily at like a single stock price. I do buy a lot of individual stocks, but I'll kind of say, look, regardless what happens with the stock over the next like 6 months or a year, If we're buying today and oil's at $27 a barrel, is oil gonna be at $27 a barrel or higher in the future? Absolutely, because nobody can make money off of the price it's at today. So I just look at it kind of like, when you have a time horizon of 1 to 2 years, you know, you gotta invest in what you know, and you shouldn't invest money for the short term that you can't afford to lose. So, that's all I would say.
Okay, I'm gonna go with one more, because we're gonna kind of been mainly focusing on the 2016, and we have a question here that focused on short time horizon. So one more shorter time question, then we're gonna go to longer term objectives. So 2016 is a presidential election year. Do the markets care who gets elected? And again, putting your own political biases aside, what do you see in terms of market reactions or lack of market reactions based on the candidate field that you see in front of you?
Bring it to somewhere else.
Anybody want to take that one?
This is a tough one to take. I will tell you, I mean, I don't think the market, I think for a lot of people that they have a horse in the race or they think that it matters, and I don't think that it matters who's in the Oval Office or the direction long-term of the economy. I think that, two things, you want to get in trouble with talk politics and talk religion, and so you want to try to be very careful with your words here. But I think, as someone who has young children and is so busy, I don't watch a lot of the news channels that are covering a lot of this. And so just in this past week, I watched the Republican debate for the first time since they've been doing these. And I was really shocked by the line of questioning and the band of misfits that I call them, that I saw during the, and again, I'm not saying that I don't believe in that type of agenda that the Republican Party puts out there, but I'm just saying I'm just really concerned, and I think that the American people probably want the presidential election to probably move the market, and I just don't know if that office has enough pull to move the market in one direction or the other. I think it's a market neutral occurrence of whoever gets the presidential seat.
Anybody else want to take that?
Sure. So, when I saw this question, I was like, right, how am I going to answer this while putting my political bias aside? So I went to some data. I went and looked at a cheat sheet. And I think you're right. I think it depends on the presidential election. I think it also depends on the outcome of Congress, because they spend the money. So, if you look at federal spending as a percent of GDP, in 1947, it was 13.8%. From 1947 to 99, it averaged 18.3%. From 2000 to 2015, that spans two political parties in the White House, federal government spending was 20% of the U.S. economy. It's been 2 percentage points higher than what it has been historically. But in terms of growth in real GDP, inflation adjusted over the first period, 3.59%. Since 2000, 1.84%. So putting those two together, I just said, well, we've had higher government spending by 2% and lower GDP growth by a little less than 2%. So correlation is not causation, but I'm just saying. I'm not an economist like Ken sitting up there, but there is a concept called crowding out. When the government spends money, it crowds out private investment. And I think that's what we're seeing. And, both parties have been spending like sailors.
So watch the spending side of the equation.
Yes.
Okay, so now so we've got a mixed audience now. We got people from the community. We have students here on campus, and through our YouTube channel, we have a lot of our finance majors that are majoring in finance from all over the world, actually. And so some of you have had portfolios for a long time. Some of you are just getting started in the investment process. So a couple of questions about strategy. So active management versus passive management. What's your view on that? And what should an individual getting started take into consideration when trying to decide how they want their funds managed?
This is something that I do research on all the time as part of my job as portfolio manager. I need to determine whether there is a way that I can actively manage the portfolios to get more results for the clients, or if there is not. And I think that there are some ways that that can be done, and but I'm not sure that right now it's possible to purchase that service for equal to or less than the amount that you would gain by it. So that's kind of where you're at with it is for right now. However, I think there are some good possibilities going forward with some what they call smart beta indexes. I think that some of those have a good possibility of, they're similar to active management, but not exactly active management, and they are much cheaper than active management. So as those come out and are commercialized, and there are a few out there. Yeah, well, yeah, well, and also, NetFavor has carrier funds, and those are using some momentum strategies and some value-based strategies, and they, they have formulas and they go through and rebalance once or twice a year, and so you're getting some kind of active management for much lower than that. And but those are very small funds right now, so they're hard to trade, they're expensive to trade, so that's where you're getting dinged on the cost of having into those funds right now. But I think that going forward, that there will be some strategies available. The hard part is going to be figuring out which ones actually are working and which ones are going to work going forward, and that's kind of always the trick to this. So I like passive for most of my clients because it's got a track record. You can have some confidence that, if you believe in the whole economy and you own the whole economy, then there it is.
Anyone else?
I mean, Jack Bogle was on TV today, and he's the founder of the Vanguard Group. And I can't really say that I totally favor one over the other because I tend to be more of an active manager type person. But I heard him say today, this is a statistic from the guy, he's a little biased, but he said that only 3% of active managers have beat the index over the course of the entire market. That's hard for me to believe because I think I use a lot of funds that I can see versus the passive index, and a lot of the funds that are like the top 10 percentile over and over again, you can find managers that consistently beat the index because they have a formula or some algorithm that they use in picking stocks. But in general, a lot of people that you hear on the media or just advisors, I use both actually. A lot of my models have passive and active because in different time periods, they do differently. When the market moves in one direction, up or down, passive is going to be index-based investing is going to be the driver of doing what the market does. So in 2013, passive management just crushed active managers because everything was moving up and widely selected when the whole economy was moving up. A year like this, depending on how we finish out, a lot of active managers may do better because, and last year too, I have funds that I use that were, I'm not saying all of them because the market still sunk last year, but some funds were up like 8 or 9% that were actively managed where the index was up 0 because they own the entire market. In general, to go on a little tangent, I think I want to mention this earlier, the market last year moved by over 30,000 points up and down, yet we finished the year flat. At the end of the day, the market follows earnings. Last year, earnings were flat. This year, earnings are expected to grow. I mean, take all the news out of it. That's a huge part of investing is believing that the overall economy is going to grow. I tell all my clients, what's the overall theme around the world? Everybody wants their kids to have a better life than they had. Everybody wants to retire someday. Everybody wants to have a good life. That theme is going to keep people consuming. The only reason you should not invest in stocks is if you think the global economy is not going to grow anymore. If people stop having babies, if people stop wanting cars and cell phones and things like that. I mean, there's this commercial on TV that says I think it was a quarter of the growth in all of human history came in the last 10 years. We're growing exponentially as a globe, and there's all these issues right now and figuring that out, how that's going to play out. But there's whole continents that are yet to be tapped into. as far as growth goes. So I think for all of us in this room that invest money, it's going to be a very long time before it's not attractive to be invested in something that's consumer-based, like stocks. So I don't know how I got there, but we're good.
I know you probably have an opinion on this, but if you don't mind, I'll jump in before you. I will tell you that this concept of active versus passive has been raging for quite a number of years. And I will tell you, it's one of those hot button topics that I think is like the difference between whole life insurance and term, right? Like there's people on both sides of the aisle who will have passionate opinions on whether active or passive is going to win the day. And there is no doubt that if you've looked over the last 6 years, passive management has crushed active management. And I believe, just like with everything, that things go in cycles. It's cyclical. Some might want to, I would assume that there may be some that will believe that passive management will win the day over the long haul, and that may be true. But in years where we just looked at the previous question, where 4 stocks made up 60% of the S&P 500, would you rather own the S&P 500, or would you own an active manager who overweighted his portfolio into those 4 stocks to give you more alpha in your portfolio? The question is, in different time periods, active and passive will work. And so for our clients in our portfolio, we try to explain the difference between active and passive, and we try to marry their beliefs with the type of management that of a money manager that manages in that fashion. And so for me, I would tell you both. It is what you need in your portfolio, both active and passive, so that in different time periods you have a little bit of both in your portfolio.
I guess the active versus passive concept, I would suggest first that, passive, we tell our students here, passive investing is when you don't think that securities are underpriced, they reflect the true value of what's actually out there. They're reflecting properly the price of the stock, given the information that we know now. And active investment, we do more when we think that we can identify underpriced securities. And I think one of the reasons maybe why active has been underperforming passive here recently is that we've learned that we can't predict an underpriced security and react more quickly than a computer that trades in milliseconds. The high frequency traders, I think, have changed that game a little bit. When you look at funds that outperform, one of the easy benchmarks for that is Morningstar. Morningstar 5-star fund. That's what everybody's looking for, right? Well, there's data out there that talks about those 5-star funds over time, and 14% of funds over a decade actually only retain that 5-star rating. Only 14% of 5-star funds retain that 5-star rating over a decade. 32% of them lose 1 star, another 32% of them lose 2 stars. That's a big difference in terms of performance. I think one problem that people have in the real world in terms of active versus passive is that they say they want to be active because they think it's the right thing to do, or they think that they may have an edge on knowledge. Whether they do or they don't is another question. But they say they want to be active, and they go out and they'll try and invest in an underpriced security, and then they completely forget about it, following it, and they don't actively watch it and participate with it. And then bad things happen to them. So if you want to do active investing, you've got to stay active. You've got to stay engaged in what's going on. You can't be passively active. You got to pick and choose. You can't mix those two together. I'm more of a passive investor.
I'll say a couple things on this. I think early in my career, I was heavily in favor of active, because mostly I was a broker. So. But I think it's gotten harder. And I've switched my portfolio from totally active to some semi-passive. I don't know if it's because markets are getting more efficient. I mean, we see that if you sit around and read finance academic papers like we do, I think there's a lot of evidence that it has gotten more efficient. And maybe that's the cause of this cycle in the last 6 years that we're in now. But I've definitely changed my feathers a little bit on the topic, because passive is so cheap. The SPY charge, 20 basis points, 7 basis points. Okay. So I think it still can be done, but it's a lot more difficult than it used to be.
Okay, the next question, and we're going to go out to the audience for another question. But the next question is, so when you get started in investing, in order to, we talked about the importance of portfolio diversification. We try to eliminate idiosyncratic or company-specific risk. We often, as young investors, we start looking towards pooled investment vehicles, mutual funds, ETFs. In fact, we've seen rapid growth in the ETF market over the last couple of decades, and yet I just had a book come out with Oxford University Press on mutual funds and ETFs, and you actually, when you look at the pooled vehicles, ETFs still only make up 11% of those pooled investment vehicles. So as we look at individual securities versus mutual funds or ETFs, and in particular the comparison between those two, what should someone consider? What's your thoughts?
I mean, everything's cyclical, like we keep saying. I mean, so in most of my managed portfolios, I mean, I have a lot of portfolios that I just charge a fee on, and then I do trading for free. But I mean, I charge a fee, but I do the trading for free. And I use ETFs mixed with mutual funds, and I use active funds mixed with passive funds. And I don't necessarily like try to predict what's going to be the best, but I have exposure to all areas. So I would just say that, like, honestly, if you have the right mix of those, that's probably going to be your way to always have exposure to what's going to be the best performing part of the market. You don't have to predict that your active's going to be passive or ETFs are the way to go. You know, I like ETFs to some extent for certain products. If you were going to buy gold or silver, the easiest way to do it is buy an ETF. I don't really want to buy a mutual fund that's going to own all the miners and things like that. You know, so ETFs are very transparent, and they're like more of a set portfolio. And I mean, a lot of passive managed funds are the same way, but with ETFs, like, you can find a fact sheet online. If you ever want to look up an ETF, just go to Google and type in whatever the symbol is and fact sheet, and it'll pop up what securities it holds. It'll tell you what the charges are, everything. So they're very easy to identify what is in the portfolio, and you know that you're getting what you wouldn't buy.
A little bit about ETFs versus mutual funds. The mutual funds operate, like you said, they're not as transparent. So when you send some money into a mutual fund, the amount of dollars that you send in gets invested at a price that's determined at the end of the day. So that's how you purchase them. And then the mutual fund company has to make transactions fairly quickly with the cash. And so they're buying and selling a lot. So there are some tax advantages to ETFs as well because of the way that they're constructed. But from an individual buying and selling standpoint, ETFs can be a little bit trickier because not only do you buy them by the share, so you don't just like throw $200 in an ETF. You have to buy however many shares worth that is. And so you have also possibly commissions for trading those. And additionally, another cost of ETFs that's a little harder to see than just the costs that they show you on the fact sheet, which are important. But also there's the trading costs, so you know the bid-ask spread, and for a smaller or more thinly traded ETF, those can be substantial. So they can be a little harder to trade. But the flip side of that is you know exactly what you own, and so it's, you know, if you know what it is that you want to buy, then that's a very good way to do it. And mutual funds can be actively managed, whereas an ETF in general is not. They have some that are sort of hybrids, but they're, for the most part, ETFs are to an index.
Just going to add mutual fund versus ETF concept. ETFs are definitely the lower cost advantage in terms of investing, and after fee performance is really what we're looking at, what our clients are looking at after fee and after tax. So the ETFs do have an advantage in that respect. And as you mentioned, the bid-ask spread, you know, there's some ETFs you have to pay good attention to the volume. How many shares are being traded on an average day for an ETF? And if you have a lower volume ETF, and you enter a period of market volatility like we have right now, those lower volume ETFs can move a lot more wildly than a peer that has a lot higher share volume, average volume. Another component with the ETFs to be careful on is in terms of how you're trading them. You can certainly place limit orders to make sure that you're buying and selling at the right price, which you cannot do with mutual funds. But I would advise do not use stop orders with ETFs. We saw people getting injured very greatly on August 24th with that. If you don't know what that is, you didn't hear about that, go home and Google August 24th ETS, and do look read. It's very, very interesting education, but I think part of the issue too with ETS is that it's kind of a digital age, high-tech kind of instrument, along with high-frequency trading and these types of things. And those aspects of our investing economy are still being regulated by Depression-era legislation. The Act 1934 and the Act 1940 are what are legislating these high-tech products. The SEC is still trying to figure out what they can learn from the August 24th event and what they can do about it and what they should have done about it. They still haven't figured it out. So I think it's going to take a while for them to really figure out how do we regulate this, how do we make this safer. So there's still some concerns there. You know, they haven't even begun to address high frequency trading. That's maybe a whole other panel in itself. But so ETS versus mutual funds, I like both of them. It's just ETS, you need to have a little bit greater awareness of what you're doing and maybe a little bit of caution in the mix too.
Buy little birds, we're getting on this anymore.
Yeah. Especially the stump orders.
I'll just say one more thing. If you guys do your research on ETFs, there's a lot of ones out there that seem really like sexy to the naked eye, because you're going to say, wow, I can get 3 times the market. And a lot of these are leveraged, so they're very specific products. So if you want to have a specific strategy, you should buy an ETF. But a lot of them are designed specifically for traders. And I can just tell you from like a broker standpoint, I'm sure Ryan's firm too, we banned a lot of ETFs. A lot of them came out in 2008, 2009. You can get like 3 times daily ETFs that use derivatives to get 3 times the market. Now that is fantastic on a day like today. If you had a market short and it was 3 times short, you made 3 times what the market did today. But a lot of people have a misconception like, mathematically, I'll just buy that and I'm going to get 3 times the market. Absolutely not. Sequence of returns is huge in leverage ETFs. So you have to be very cautious. I know for me, like when I was in school, I had a stock trading account because I was like, I want to do this. And I was buying all kinds of risky stuff, you know, and it wasn't like a ton of money, but it was just like more fun. So if you're investing for the long term, don't be fooled by looking at something and thinking like, this is the answer. Like, this is definitely what I should be buying, because if the market's going to go up, I'm going to be 3 times the return. A lot of data would show that like it's nowhere close to that over a longer period of time.
Yeah, with those leveraged ETFs, if you're right on the market direction, you can be very right and get paid very well. But as soon as you're wrong, you're in a lot of pain. So you can do it for certain periods of time, but if it goes against you, it really, really hurts. And I do a simulation in the investing simulation in the investments class I teach here at Barron. And almost every semester I have at least 1 or 2 students try leveraged ETFs. And usually they try their way through about half the semester until they sell them and then move on to a different type of investing. Because most people can't pick the timing perfectly. Some people can. But most people can't pick the timing correctly. They get in, get out.
It's a game.
It's doubling down.
So leverage ETFs equal Vegas, is that what we're saying? Anything else? Okay, at this point, we'll open it up to questions from people here.
Great, thanks. So just a theoretical question. If today you were to say that the market was looking like it was going to go into recession in the future, what option would you take? Would you stay the course? Would you move mostly to cash? Or what other investment options would you kind of go with? And as far as the investment options, would you stick with any type of ETF or mutual fund that has a different correlation in the market? Or just what kind of action would you take in this situation?
Josh Brown had a tweet to answer this, so it's pretty short. Yeah, it's pretty good, yeah. If you sell everything now, number 1, if you are right, when do you buy back? Number 2, if you are wrong, when do you buy back?
I'll kind of say this, like, I would echo that point. I mean, you have to look at what the money's for, so these type of times, like, we're constantly reminding clients, like, what are you saving money for? If you're saving it for the short term, absolutely. If I thought there was a recession coming, you know, in general, I don't mind moving money around for people. I do move money on a regular basis. And I would probably still go to, if you thought we were going to be in a recession, typically the best performing part of the economy in a recession is going to be like a government note. Even, you know, that's in finance class, that's a risk-free asset. You know, that's an arguable point, but it is, it's still a risk-free asset. So typically you're using the money flow go to the safest, highest rated securities. So even though treasuries seem like you can't make money at 1.9% today, believe it or not, you know, that was much lower on a 10-year note, even in the recession. So I think in 2008, treasuries were up like, I heard something ridiculous, like 15% or something like that. But most bond funds were up like, the good ones were up like 4 or 5%. So there are places to hide. I can just tell you guys this, like a lot of my clients, I buy a lot of individual securities, and I can still get 6% on a note that's rated investment grade today, and for par, for what it's worth. So there are places to go with your money, even though the news doesn't want you to feel that way. GE right down the street, you can buy a GE bond today for about what it's worth for about 5% fixed interest. And that's a pretty good rate of return if you're feeling like the economy's not going to do much. So there's still things out there that pay really good fixed rates. And that's where I have been putting money recently for clients, because if the market's going to do hopefully 7%, why hope for 7 if we can definitely make 5 or 6? You know, so just transitioning money into places that are going to be where the money flow is going to go ahead of time. That's what I would do. And I'm not a huge fan of cash, but cash is okay for a short period of time. It is an asset class.
I think that would also be probably increasing the allocation to treasuries more so than corporate debt. Corporate debt can sometimes have issues on downgrading risk, particularly the higher yield assets. S&P just said that they have a lot more companies on downgrade alert right now in the high yield space. So I'd probably be more a player in the mid-duration treasuries, the 10-year area treasuries as a recession hedge. That's probably more my flavor.
Doesn't GE have a higher credit rating than the US government?
It's the same, actually.
It's the same.
They used to be triple.
Just checking, right?
They used to be AAA.
Any other questions? Questions from the audience?
So I know oil's been the hot topic, but I like how you guys touched upon, you know, automobiles moving toward batteries. And I know Elon Musk, he wants to make a battery that can power your home eventually. And, you know, I'm 23 years old, and I'm looking for a stock that I can hold on to until 50, maybe 60. What makes you guys really think that oil is going to go back? And even if it does, is it always going to be that hot topic for us, you know, 20 years down the line from now?
Obviously, I'm very bearish on oil and oil. That's it. I don't really have anything.
And again, I'm not a stock picker in general, so I'm probably one of the worst one on the panel here to tell you what stock at age 20 to hold for the next 30 years is going to be a winner, right? Like I have no idea in the big picture. But I will say, I kind of a little bit disagree. I mean, I think that with maybe some comments earlier about energy, in the sense of I get a lot of information from a lot of these energy companies, and I would tell you that energy at the time, and this was early in 2015, because of the amount of natural gas that we've been able to find here with Utica Shell, Marcellus Shell, and stuff, and a lot of that has stagnated since oil prices have dropped drastically. The exploration of natural gas, a lot of those companies are just cap their wells, and they're just, why pull money out of our own ground when we can buy it? But I still believe that, you know, energy, I'm not a huge fan of these alternative energy, wind, solar, battery-powered homes and vehicles. I would tell you, and this is just my own personal opinion, not that I have anything to go by it, but if energy is going to stay low, and I perceive that it's going to be low, and America's the #1 energy producer in the world right now, and it looks to be on pace that we will be for the foreseeable future. If that's the case, I just don't see the other alternative energies ever getting to the place where we are going to want to drive a battery-powered vehicle for the lack of performance that it probably gives us compared to what a hydrocarbon fuel is giving us in the form of BTUs and stuff to heat our homes and to drive our vehicles. Now, that is in my lifetime. I will tell you, maybe the next, my kids' generations, that hydrocarbon fuels will be so expensive to pull out of the ground because of the lack of that resource, that we're not using those anymore and some of these alternatives. But I would think that solar and wind and battery powered stuff is gonna take a back seat, I think personally, for a long, long time.
I agree with Brian. It's gonna take a long time to get renewable energy at a practical cost. And maybe it's gonna happen here first, but there are billions of people in the world who live without electricity, and live without, heat or air conditioning. So are they gonna go straight from poverty into an Elon Musk powered house? Probably not. They're probably gonna have a hydrocarbon step in between. So, yeah, I'm not real bullish on them. But maybe someone will invent cold fusion tomorrow over in the engineering.
I'm personally not really long-term bearish or bullish on really anything in general. I think there's always new information that comes into play that changes your perspective. Could be something new that happens next month to completely change our viewpoint. On inflation, every one of us might be, in inflation, thinking inflation's around the corner based on new information that we get next month. It's constantly changing. But in terms of stock, selection, I know that I personally do not have the time to do the kind of research that Warren Buffett or David Einhorn or Manish Babrai or some of the peers do. I'm not going to try and compete with them. So if you have a really long time horizon, where you are now and going out 20, 30 years, I do have a stock pick for you. SPY. It's the Standard & Poor's 500 in ETF form. So,
good evening, thank you for coming. I just had a quick question coming in here. I wanted to know if any of you are optimistic on any specific sectors for the 2016 year. So just really a 1 year time frame.
I mean, me personally, the consistent outperformer over the last 5 to 6 years has been healthcare. And like last year, it outperformed in a huge way again over all their asset classes as far as like the sectors go. So I would tell you that like where I've been putting money for a lot of clients, I don't like heavily invest there. If I build a portfolio, maybe I do like a 5% allocation to this, but I would do like science and technology, something like that. So I think tech, it's going to continue to evolve. I mean, who would have thought 40 or 50 years ago what a computer would have been? How much we needed our smartphones. And, like Sue said, we don't know what the next leg's going to be, but there will be a new technology revolution coming. Who would have thought our grandparents couldn't have thought about computers, like that we would have it in the palm of our hand, but we do. And I don't know what the next thing is going to be, but there probably will be some crazy breakthrough that we won't be able to live without 40 years from now. So, so right now I think tech and healthcare are the big thing. I mean, 10,000 people a day are turning age 65 in this country. They need healthcare. And that's the theme that is not going to stop in this decade or the next decade. So personally, with my money, I would do some mix of technology and healthcare, and then when energy bottoms out, absolutely.
Again, a time horizon of 2016 only, I think, you're playing the roulette wheel and putting your chips on specific numbers and just hoping for 2016. And so, good luck for something in a sector that's going to make money for 2016 after we saw today, who knows? But to answer your question, try to give you a really good answer, I agree with Adam. You look at the places, I look at what has really had regression over the last year or two. If for all the women in the room, and I guess it's probably a little bit of a sexist comment, so let me get back. But anybody who is in the room who likes to buy things on sale at the mall, right? If the mall was on sale, everything in the mall was on sale by 50% or 70%, would you want to go and take a look to see what type of shoes and clothing, you might want to add to your order? And the thing is, when I look at it, what has really regressed over the last year, and so I'm a huge fan right now, if I was going to over allocate or reallocate to a different asset class. As Adam said, you look at the numbers, technology and healthcare are definitely places to put some heavy allocation, but for me also, energy, I think we're in a third inning of a 9-inning ballgame in energy, and so because energy's been so low, I think that it's attractive. I'm a huge fan of overweighting to international stocks and overweighting to small company stocks compared to the S&P 500. So I know that SPY was the S&P 500, but I would think that if I was trying to get more alpha in my portfolios, having exposure to international markets, especially emerging markets, and also small caps over time have outperformed large cap, and especially since large caps lately have been the dominating top producer of all the different asset classes. So hard to tell for 2016, but if you give me a 5 or 10 year, internationals and small caps and energy will be an awesome play.
Anything else?
I think most of what I've been hearing or reading about from large money managers, large money management firms, is that this year, 2016, is not going to be so much a stock picking game as it is going to be a volatility reduction. We're probably just going to see a lot of volatility this year with all the uncertainty and confusion and emotions in the stock market. So I think right now, in terms of one asset class that I would probably be more tending to overweight would be the treasuries area, to try and reduce some of that volatility, trying to beat the market by having less volatility than the market, not necessarily trying to pick the sector in the market that's going to do less bad than the others. I think I would try and pick something that would reduce that volatility and maybe overweight my treasuries for the shorter time period.
Just one last thought. I agree with Brian Adam. Healthcare and tech are the place to be for the long term. For 1 year, I would add, this year I'm looking more at some consumer defensive stocks, or maybe even some discretionary ones. The economy's still chugging along, but I don't think it's going anywhere fast. So I believe Macy's was up today. So they were down. So that's it. For the short term, the more defensive stocks for me.
Okay, panelists, closing comments, things that you might want to just have kind of parting words of advice or wisdom you'd like to bestow upon the folks here.
I guess one comment I would make, and I do tell all of my students this, but for those of you who I don't have or haven't had, or some of you that are students, if you don't understand what will make the investment go up or go down, don't invest in it. Whether it's a short period or a long time period, if you don't understand it, leave it to the side.
Just my parting shot here. This is a discussion I give with a lot of my clients, and this is where I transition my practice. I'm going to give you an analogy that I use with my clients that I think resonates when they try to understand investing. And so there's different ways to have your money invested. There's different approaches to allocation. And depending on where you're at in the time horizon and your risk tolerance levels, you will go through different changes of what's important. And I will tell you, for someone who's young, and most of the people in the room here have a long time horizon, strategic investing, whether you're using assets, active or passive, over time, strategic investing is the right way to do that. And so some of you might not know what strategic is. Strategic investing is just having an asset allocation of so much in stocks and bonds and different asset classes, and just staying the course. Staying the course over time has proven to be the best way to make money over time. It's like putting your money in a sailboat and just putting a bandana around your eyeballs and taking a siesta and waiting 10 or 15, 20 years to figure out where you're at 10, 15 years. And typically the wind behind your sails has pushed you down the path a lot farther than any other type of investing. But in different climates, other people like to have their money managed in different ways. And so whether you want to use a sailboat that has a rudder and you can try to predict where the wind's coming from and move left and right and try to outsmart asset allocation, or whether you wanted to have something that turns into a submarine. I think as a financial advisor, regardless, my job as a financial advisor is to understand whether my client is the owner of a football team, and I use this analogy a lot. Whether you want to be defensive or offensive in your posture. So if you want to be offensive, maybe you want to have a portfolio built like the Pittsburgh Steelers that throws the ball down the field and has wonderful wide receivers. Maybe you want to be more defensive like the Buffalo Bills, and you want to build a portfolio that is built on running and defense. But I think we can all agree that nobody wants a portfolio built like the Cleveland Browns.
Anybody else?
First, I want to echo what Aaron said. Don't invest in something you don't understand. I think that was Warren Buffett's advice as well. And don't try to catch falling knives.
I would just probably say for everybody, a commonality would be a good quote that I have, and every one of my emails I have a quote from Ben Franklin that says, "An investment in knowledge pays the best interest." If you can really take the time to educate yourself about what is out there, and don't just buy the first hot thing. I mean, sometimes clients call me and they'll say, "What do you think about this stock?" And I'm like, "Well, why don't we just sit on it for a day?" Because maybe it's just like a feeling you're having. Don't let emotions run your investment decisions. Educate yourself, read books, read articles, we have a lot of good resources here. And I mean, I graduated like 7 years ago or 7.5 years ago, and I still talk to, these people on a regular basis. So you can always find information out there about what you're investing in, but educate yourself. And in the real world, a lot of you guys are going to be, most of you guys are in finance, so if you're going to do the job that we do, I really do my best to educate my clients about why things happen. I don't expect people to understand the intricacies of each investment, but most of my clients do have an understanding of why the market's doing what it's doing, and that lends itself to calmer times when the market is like this. I got probably 12 phone calls today, and 9 of them were to buy something. That means I'm doing my job well. So if you can, take the media out of it and just educate yourself, you'll be calmer, and your clients will be calmer. And if you're behind the scenes, you'll make more informed decisions over time. So that's my advice.
Well, I agree with pretty much what all these guys have said. I mean, you need to educate yourself, and whether you're investing for yourself or for someone else, you need to make a plan, and you have to stick to the plan. Sometimes that's a lot harder to do for your own investments than it is for a client investments. But it's very important. That's what makes the plan succeed, is following.
Ladies and gentlemen, would you please offer a round of applause for our wonderful panel. Okay, so a couple of things. So we have refreshments. Obviously, the folks joining us on the YouTube channel can't indulge, but we do have refreshments up here if you guys are interested in this. Our next finance speaker series will be on March 23rd. We're going to be talking about basically investment policy statements and how to set up a plan for your own personal portfolio. We've got guest speakers coming in from the Joseph Group in Columbus, Ohio. So thank you all for being here tonight, and we'll look forward to seeing you again at our next event.